How do you handle a failed investment? Excellent question. In the TV series called Billions, the resident psychologist says, good traders feel good about themselves after a good trade. Meanwhile, great traders feel nothing. I guarantee this is the aspiration of all profitable traders. My story: I used to be super emotional about failed trades. I used to take it very personally. A trade did not fail. I did. The ironic part is I intellectually knew it was just a stat, a data point in a long row of data set. Still, it would claim its pound of emotional flesh. Part of mindset comes from the fundamental investing mentality. You are supposed to have done your research and you are expected to defend it. With that said, I take full responsibility for my track record. Not too long ago, I told my wife I had back to back the best and worst one day of my career on my personal account. I just clocked half a year's worth of rent in paper profit, quickly followed by, I just lost 1 year worth of rent paper profit. Here went the dishes on the floor, and I remember in that instant that I felt nothing at all, mildly amused at her face maybe. So, how did I transform from an emotional marshmallow to trading clinical psychopath? Thinking in bets. Market wizards come in all shapes and forms. Yet, all of them have one common denominator: superior risk management. Money is made in the money management module. Beginners to intermediate traders are trapped in the hamster wheel of better entry. 5 years down the road, with all the research, bells and whistles, they are still stuck in the same rut. The irony is they have a seemingly random proof process and yet generate random returns. Compare this: casinos where there is random outcome, but those houses still generate non-random steady cash. This has everything to do with the mindset you bring to the table. If you think in bets and statistics, you will be able to milk random series. This is a formidable kick in the genitalia for all the efficient market hypothesis apostles. In this context, bet too much and you are out of business, bet too small and you don't have a business. How to transform from marshmallow to Terminator. The irony is deep down everyone knows the answer. Build a trading system with a positive gain expectancy. Nothing happens until gain expectancy is positive. Dynamic risk. No system will consistently spit money. Bet according to the success of your system, bigger when it works and smaller when it does not. Execute your system faithfully. This is really hard. Who has ever second-guessed their stop loss or entry? The minute you override your system, you trade something else. Bottom line, trust your system. Executing your system should be as exciting as baking bread. In comparison, soporific marathon speeches by Haufoe Boini should sound like cliffhangers adventure novels. Pre-mortem. Tourists bet the farm, pros, milk the cows. In the previous paragraph, dynamic risk means risk is not a constant. No one drives a car in first or fifth gear. The whole idea is to delegate the value of risk to the markets. Calculate the cumulative sum of gain expectancy normalized in units of risks. Then, run the convex oscillator. This will the nominal value of risk. My sleep has considerably improved since then. I believe this contraption will become a staple on every trading desk in the next 10 years. Imagine the market giving you direct feedback on how much you should be betting at any point in time. Thank you for your time and see you later.